Well, it's great to be here with you, Peter. I should say at the outset, for those of you in the audience who don't know Peter and his career, that he was one of the people whose job in terms of AIG was to put Humpty Dumpty back together again. He wasn't one of the guys who gave it a great fall at the beginning. Peter, let me just start by asking a kind of what are you doing here picture. The historical view of the crisis and how it and AIG's part in it has been reduced to something of a soundbite now, something running to all the bad trades, AIG was the counterparty. Maybe you can take a minute just to set the record straight about what kind of crisis AIG had, and then we can talk about your role in helping it recover.
Well, I think, first of all, thank you very much for the opportunity to talk about something that's obviously near and dear to my heart, and I really appreciate the comments we've heard so far. This has been a really informative discussion, and very pertinent to what I wanted to say. And Debbie's comments, I couldn't agree with more, that the accounting for the cost of the bailouts has been all over the map, and the level of understanding of the ins and outs of AIG, the pros and cons of what happened, whether it was a victim or a perp, has really muddied the waters in terms of my job in trying to, as you say, put Humpty Dumpty back together again. In other words, to continue to serve the millions of customers around the world that relied on AIG for its services, and to recover as much value as possible for all of the claimants. So I think that with the perspective of 10 years, we are away from the heightened venom that occurred in the year before I joined. I joined in February 2010, and it was a year before that several employees had death threats. Their children were beaten up in school. The employees were spat at in the street. So this was a company that was vilified. The brand was literally as low as you can get, which I believe was unjustified. Clearly, there were many things that could have been done better, but I think that this was, as I think everybody has said so far, a systemic crisis, and the sequence of institutions that were toppled by the liquidity crisis was somewhat random. And so there are other large institutions that relied very heavily on the assistance from government that ended up with very modest impact on their brands. That's, I think, an important backdrop, because you can get very quantitative about the pros and cons of the bailout, whether it could have been more efficient, but forget about the human dimension. And at the end of the day, institutions are made up of people. Bob Merton talked about the importance of trust. And I think whether it's trust within an institution, between employees and their management, between shareholders and a company, or regulators in a company, the level of trust in AIG collapsed. And I think that's an important backdrop for thinking about how you restore trust in the aftermath of a bailout to recover as much of the going concern value as opposed to resort to the liquidation value of the company.
But I think it's fair to say that a lot of people were surprised by the many kinds of risks that what they thought of as a general insurer were taking. What they found, what part of that anger was just, we thought this was an insurance company, and it seems to have a trading operation attached, floating freely from the basic risk transfer function that companies like that are supposed to have. Was that a misunderstanding as well?
I think that for those that were better informed about the company, they recognized that this was a company that was in insurance in about 200 countries in the world of all forms. It was one of the two largest aircraft lessors. It was one of the largest commercial property developers around the world. It owned banks. It was a financial conglomerate with industrial holdings. It was very diverse in its activities. I think the biggest surprise was that how could something that was rated AAA so recently suddenly be out of cash? How could something with $1 trillion balance sheet going into the crisis not make a collateral payment to Goldman Sachs and other banks that were calling for collateral. And I think that the surprise was this sort of mismatch between the degree of unquestioned confidence that its balance sheet had fairly recently, before the crisis, to the sudden collapse of that confidence. And that, I think, is worth examining as to how do we prevent that misplaced confidence in very large institutions.
Well, why don't you go ahead and answer the good question you just posed. With 10 years of hindsight to think about it, how could a company of that size and that degree of diversity go from AAA to bust?
So I think that one of the things that I really learned coming into the industry from out of the banking industry in my earlier career was quite how balkanized the regulatory framework is for insurance companies. So AIG was regulated by well over 200 different regulators who jealously guard the capital ratios and liquidity of their legal entities. And so when the holding company has to come up with collateral, upstreaming cash via dividends from those various subsidiaries, A, takes time, and B, takes the agreement of a lot of stakeholders, notably regulators. So understanding that a frictionless model of enterprise risk is an abstract rather than a practical concept was an important learning. And I think especially our banks have moved to a more ring-fenced structure. So the stress tests need to be much more precise in evaluating the frictions that inhibit the free flow of capital and liquidity between geographies, between functions and legal entities. And so it's more complex than perhaps some of the simplified enterprise risk models that were applied would suggest.
Well, we still have some very complex and diverse and large financial institutions with multi-trillion-dollar balance sheets. And as a financial analyst and as a reporter, I still flip to page 1 and I look at the consolidated balance sheet to assess the financial strength under stress of the organization. Is that itself a risk? And how do you handle that risk?
So
I'm thinking of, pick your institution, JP Morgan's balance sheet,
clearly size brings with it broader systemic consequences. Does it increase the probability of failure? And I'd say no. Larger institutions can usually afford better investment in things like cybersecurity and probably more money spent on stress testing. And so to some extent, scale brings with it safety.
Yes.
But obviously, then the severity of the societal impact of a failure is greater. I think more than size, complexity is an issue. And more than size is a convergence of business model. And so I think that the attempt to standardize capital models and the failure to distinguish between beta and sigma in the way in which risk is evaluated has not rewarded institutions to specialize. So if you look at most large financial institutions, they tend to share very similar risk profiles. And I think the stress test initially started to tease apart the two by saying, what is the relative exposure of different institutions to exactly the same scenarios? In subsequent stress tests, I saw a more eclectic mix of risks thrown into the pot of those stress tests. And I think you lost a lot of information value when you did that. So obviously, an interesting stress test in 2006 would have been what was the exposure of each of these institutions to a spike in mortgage defaults. Yes. And that beta to mortgage defaults would have been a useful thing to benchmark against companies and would have been a different answer to whether they were capitalized at 8, 10, or 12%. Because I think isolated defaults of even large institutions, if they're the only institution exposed to a given risk, has a fundamentally different impact on the system than a simultaneous default of many, which is, I think going back to the earlier conversation about the smaller banks being exempt. If they're all exposed to the same risk, if they all go down together, that's a problem. Think about the Texas banking crisis of the 80s with the oil price exposure. So I think that we need to think carefully about mushing together vol measured by sigma with beta and really have better incentives to have more specialized, simpler institutions. Because I do think that supervising, rating large, complex institutions is a huge challenge to both the regulators and the rating agencies. And so I don't underestimate how hard it is, and so making it easier for them to do a good job would be a good thing.
It's one of the remarkable features of the 10 years since the financial crisis that the institutions may have changed, but the rating agencies and the structure of the rating process is substantially unchanged. So when you call for a kind of ecosystem of financial companies that is more specialized and diverse, are you suggesting changing the industry because the rating agencies are too hard to change? Or is it too hard to rate complex institutions, or there's not a better way to think about risks? You actually have to change the institutions themselves?
Well, I think the question is, are we solving for reducing systemic risk? Are we solving for optimizing shareholder value? Or are we optimizing for enterprise value? And I think the answer is slightly different depending on those things, because I think the rating agencies are worrying about the debt holder, and I think that they could do a better job for the debt holders of large financial institutions. But I think the moral hazard dimension is that the debt holders of large financial institutions assume that there will be a bailout. So I think that, I do believe if the rating agencies said, look, we have absolutely no clue whether these large banks should be rated single A or single B because they're just too complicated, then I think you'd have an incentive to greater simplification. And that wouldn't be a terrible thing. Because I think that the rating agencies are the de facto regulator of these companies. They are embedded in financial contracts. They trigger collateral terms. And so I think that we have to sort of judge whether over those 10 years, the critical role of rating agencies in rating institutions, not structured finance, because that's where a lot of the critique of the rating agencies fell, but in the institutions themselves, has it really adapted to the difficulty of really evaluating the creditworthiness of this company, absent the contingent bailout?
Talk about the work you had to do to protect value for the various shareholders at AIG. Substantively, when you landed there, what was the work that needed to be done, and how did you decide to do it?
Well, I arrived in February 2010. My CEO at the time, Bob Benmosche, had arrived about 7 months earlier. And the first thing was to sort of look around and see who on the sort of leadership team was able to sort of come to the rescue. And I was very pleasantly surprised by the quality of the team that was on deck. And that was critical, because the pace at which decisions had to be made was enormous. We had, I think, 120 board meetings in 1 year. And many of them were at midnight. It was an absolutely extraordinary pace. And so it put great strain on there was no bureaucracy. You had to get to the substance of issues. We were extremely lucky in the counterparts at the New York Fed and the US Treasury that we faced off against. Sarah Dahlgren at the Fed and Jim Milstein at Treasury. And so evaluating who were the players that we would be dealing with really helped to shape what were the degrees of freedom to come to a solution. The other thing that was clear, going back to the trust issue, was that I had made the naive assumption when I joined was that the counterparty was the government. And anybody who's dealt with the government there's no such thing. There are multiple departments within the government. And because the nature of the bailout of AIG occurred pre and post TARP legislation, there was multiple ways in which the assistance had been provided. And each of them had different governance and different objective functions, from being senior secured creditors to being TARP preferred. And so we had a stakeholder group, including public shareholders, the float never stopped, debt holders and so on, and a rating to maintain, that meant that the capital structure that would be feasible in the long term had to be designed with the cooperation of all these stakeholders. And when we arrived, we were stuck in a world of zero-sum thinking, going back to our first talk this morning. And we had to persuade people that the whole was worth more than the sum of the parts, that everybody needed to compromise. And so we came up with this concept of a peace dividend, which intuitively everybody could get. You know, if only everybody could compromise just a little bit, give a little bit, then the enterprise value would go up and help everybody. And interestingly enough, we applied the work of Bob Merton's contingent claims approach to estimate what that peace dividend was worth. And we worked with Andy Lowe, in fact, and used a jump diffusion model to show that if you could reduce the probability of a reversion to a fire sale, you had about $13 billion of value to share among all of the stakeholders if you could only reach a sustainable going concern capital structure. And so that was a very helpful application of theory into a very sort of intuitive human dynamic of how do you get people to buy into collective action when that was essential. And you know, in contrast to some of the other bailouts where action was deferred and deferred and deferred, we were able to shift to a strategy of preserving a core of the business, selling off dozens of companies, unwinding trillions of derivatives, de-risking the company, and focusing on a going concern, and keeping 60,000 employees excited about continuing to work there by virtue of getting that cooperation to happen quickly. Because every quarter that went by that the issue was not resolved, customers were departing, employees were departing, is a melting ice cube. So speed was of the essence.
How much of the effort of realizing what you called the peace dividend came down to just getting creditors or claimants to be patient? I mean, was it a matter of, I know you're first in line, but if you can just wait, right, we can, you know, talk about the human element a little bit
I think that sort of preceded the peace dividend and really coincided with the arrival of Bob Benmosche. And there's a wonderful C-SPAN video of him testifying in Congress, looking at the congressional panel in the eye and say, we will repay every dime of the bailout. And people just laughing in his face, literally laughing in his face. Because at that moment, the CBO was estimating a loss of $40 billion. And so the ultimate simple cash flow approach, which Debbie dismisses, but our good president at the time used, so I'll use it, was that it was a net positive of $23 billion. So $182 billion, but the $23 billion more than that paid back. But in a relatively short period of time, that was all done by November 2012. So I think it was fairly compressed. But I think that the key point was when Bob Benmosche had that conviction, it started to resonate with employees, with customers. And so rather than the peace dividend, that was just saying that the mean of the distribution just jumped up by about $40 billion from a fire sale liquidation under the previous regime to this is worth saving. Even if you can't save all of it, you can at least save some of it. And the part that was saved is still the largest insurance company in the world. You just taken away a lot of the other distractions that caused a lot of fear. The derivatives trading business, the aircraft leasing business, the consumer finance business, the bank, things that pose contingent liquidity risk that probably didn't belong in an insurance company group.
Your bailout happened 2 days after Lehman. Tell me about the impact on the process of the order. You talked about the order being somewhat, the order in which companies got into trouble and got bailed out being somewhat arbitrary. from where, where you were sitting?
Well, I think that ex post, with lots of time, we can say, well, the AIG bailout was pretty effective. It got the money back. The shareholders and the management got punished very severely. Should be a perfect prototype for future bailouts. I think anybody who was there at the time would say, you've got to be crazy. This was an incredibly complex process. There's got to be a simpler way to do it. And I think that the sequence meant that every day that went by, the level of fear of a massive contagion was going up. So the willingness to go to ever more extreme measures to just put the fire out got greater. And the ability to take risk, political risk, I would say, in making very unpopular choices rose. And we'll hear tomorrow from some of those decision makers. I have huge respect for the policymakers that stuck their neck out and did what I think was the right thing, even if you could be a Monday morning quarterback and question the precise way in which it was done. Inaction would have cost society far more, in my view. And so I think that the sequence meant that there was heightened fear that this would really go out of control if it wasn't done, because I don't think anybody really expected to have to deal with an insurance company, for heaven's sake. Yes. But obviously, Goldman and Morgan Stanley becoming bank holding companies a week later was another implicit bailout. So that it kept on cascading, but in different forms as the weeks progressed.
Let me put Professor Lucas's challenge to you directly, that if I understand her reading of the true cost, the economic cost of the bailouts correctly, is that, as it were, insurance was extended at a time when that insurance had a lot of value, that on a risk-adjusted basis, there was economic losses associated with the bailouts. What do you think about that critique? I hate to tear you away from President Obama's accounting system.
I think it's a very legitimate approach. I think that her last bullet point was the point that you can look at the aggregate cost of the bailout in a cost-benefit analysis and say, in the counterfactual of not doing any bailouts, what would have been the cost to society? So I think the externalities of a failure of all of these institutions, starting with Fannie and Freddie, the FHA, and AIG and all the major banks, would have been absolutely catastrophic. So I think it was a bargain, but could it have been cheaper? For sure. I think a lot of prudential things could have been done differently in the preceding years, and so I think that specifically to AIG, and obviously that's where I can speak most candidly. In the years that I worked there, which is over 7 years, I met with customers in over 50 countries who thanked me and thanked the company for continuing to exist, because they said they would be out of business without AIG's insurance. It insured hundreds of thousands of businesses, tens of millions of people all around the world, and was a critical part of the fabric of international commerce. And so I think that it was a company worth saving. And today is, I think, a more focused, more specialized company than it ever was.
So let's pan out from AIG to the financial system generally. Before you were at AIG, you were involved in the derivatives business and in banking business. With 10 years of retrospect, lessons learned, lessons failed to learn.
Well, I think I was at JP Morgan between 1980 and 2000. I was an entrepreneur between that period of time and ending up at KeyCorp after their assistance, and then at AIG. So during that period of time, I saw a lot of changes in the way financial instruments that I had been involved in, swaps and credit default swaps and so on, were used. And I think, like any powerful tool, they can be very useful, but they can also be quite destructive if misused. And I always felt that that CDO technology was ill-suited to repackaging mortgage risk, because going to my point about sigma and beta, they essentially rely on diversification as a risk tool. And when you've got 1,000 mortgages in Arizona, adding another 10,000 doesn't add to the diversification.
No.
And so I think that having an effective futures contract to be able to hedge the systemic housing risk would have been a helpful alternative way to recycle that risk. But I think that the industry went down a different route, which is to take a technology which was better adapted to sovereign credit risk and corporate credit risk and apply it to mortgages. But you know, I think that the other thing which I have really come to appreciate much more, and I experienced in the early part of my career in the 1980s, is legal enforceability risk. So when Hammersmith and Fulham, the local authority in the UK, was determined to be acting ultra vires when they were entering into interest rate swaps, suddenly the banking industry was exposed to having unenforceable contracts to all of the local authorities in the UK. And likewise, late in the 90s, when there was a risk that all over-the-counter derivatives would be designated as unenforceable off-exchange futures contracts, there was a risk of enforceability that would have been even more catastrophic. And I'm not sure that stress tests today sufficiently look at counterparty legal enforceability as opposed to credit risk, because jurisdictions will determine whether these counterparties will pay, and they may be whole groups of them. So I think that greater attention to legal enforceability, because I think that the aftermath of the crisis gave rise to a lot of litigation around that, and I'm not sure that's been fully appreciated. So simplifying the books of business. You've still got many of the large banks with tens of trillions of notional. That's not the right metric of risk, but it's a starting point for saying, okay, let's get to the bottom of where the risks are, including legal enforceability risk.
Well, when we talked yesterday about taking questions from the audience, we concluded that you never know what kind of nutcase shows up to an event like this, and we decided not to. But I got an email from Peter this morning that said the nutcase ratio seems to be relatively low, and it might be safe to take questions from the audience. So with that in mind, would anybody like to put a question to Peter? Not you.
I'm willing to be the first nutcase. But talk a little bit about counterfactual.
You identify yourself first?
Oh, I'm Doug Carr, our Spin Institute. Talk about a little, you mentioned counterfactual. For the world of AIG, the counterfactual, no bailout, your FIP goes bankrupt, presumably takes the holding company with it. I'm sure there were guarantees. The insurance companies, I was a customer for a while. I mean, they're okay, right? They're well. A counterfactual for the bankruptcy of AIG, would you have been able to limit it to financial products and the corporate parent? What would have happened to it's hard to speculate about the markets, obviously, but what would have happened to AIG?
So it's obviously a speculative argument, but I'll mention one thing, and there's a nice paper published, I forget the professor's name, I can dig it up, about the fact that the securities lending activity that occurred within the regulated insurance company was facing a loss almost as large as the unregulated derivatives activity at the holding company. So the simple answer is the risks of liquidity mismatch and the ability to meet collateral calls would have been not only at the holding company but deeper into the insurance companies, and so I think it would have been much more painful than some people think. And the cross default clauses are something that also people, a lot of people talked about. Oh, surely you could have got a better deal on the collateral and so on. If you start haggling about getting haircuts, you immediately start triggering cross defaults, and then how many other forms of debt start to cascade, and you can't finance yourself. So I think that that's hindsight thinking. It's not a simple corporate bankruptcy where you can negotiate haircuts with lots of time. It's a wholesale financial market where you're rolling over debt every night, and once you start triggering cross defaults, there's no going back. So I think that the answer would have been toast. Technical time.
Please. The microphone will come over shortly.
Thank you. I'm Lillian from PIMCO and also an MIT graduate. Thank you very much for sharing your insights. So I especially like your comment about the rating agencies and the importance of rating agencies to act as supervisors for companies. So since financial crisis, we have observed that rating agencies have been more tolerant of higher leverages in the corporate world. So this is especially pronounced during the QE period, which is understandable because of a more supportive macro environment and also lower interest rates. So going forward, say if in the future we encounter another crisis, do you see a larger chance of the history to repeat itself, or do you think that the rating agencies will be more constructive next time in terms of warning people of potential risks?
Well, I was, and is anybody here from a rating agency here? I'm going to give them a plug. I think that for especially large financial institutions or any borrower that has large amounts of debt, they could get away with charging roughly 10 times more than they currently charge. I'm astonished by how little the rating agencies charge and how much they underestimate the economic value of a good rating to a counterparty. And I think that means that they just simply don't have the resources to do the kind of analysis that would be really helpful to a sophisticated institution like PIMCO. So I'm assuming PIMCO has more than enough analysts to do their own homework and don't rely on the rating agencies, because I think today they're still massively under-resourced to do really good work, and in particular to estimate the impact of a change in monetary policy, the change in the yield curve, the impact of unfunded pension obligations, and the potential ALM mismatch of asset allocation within in pension funds. These are things which I don't see in the typical ratings reports analyzed to a degree of accuracy that I think are going to serve us if we get a regime shift. So I think they tend to be rather backward-looking and extrapolating recent past as opposed to capturing inflection points.
I'm Gordon Liu from HSBC Risk Management. Thank you very much for sharing your thoughts. The question a little bit specific for the CDS. That's the products offered for corporate CDS from AIG at the time. So given the insurance normally have millions of people to do that insurance, but for corporate CDS, you can liquid about a couple of thousand in their part. So my question was, what kind of discussion was debating internally? I know it's before your time, why that product being offered? Because apparently, if you offer too expensive, nobody buy, too cheap, you could have multiple defaults for one contract. So additionally, for all the other products, what kind due diligence that's within the company been doing that? Okay, thank you for answering this.
So as you point out, I wasn't there at the time, so I'm not sure who asked what question, and there may be people here who were there. Most audiences of this size have at least one or two AIG employees in them. But I'll answer the question in broader terms, which is that you're right, insurance works best when you have thousands, if not millions, of uncorrelated risks. And I think that there are certain forms of insurance that don't have that. And so I'll give you some examples. One is the variable annuity business in the life side, where you have substantial systematic risk to interest rates and equity markets and equity volatility, which by adding another million individuals doesn't go away. And so the traditional actuarial reserving methods don't properly capture that. So that's one example. Mortgage insurance. AIG was the owner of United Guaranty, which became the largest mortgage insurer, quite separately from the CDS. This was an insurance product regulated by an insurance regulator, Again, the systematic exposure to housing prices was not captured by the traditional actuarial methods. So I think that there are other areas in the surety insurance business, which is effectively a credit product, where, again, traditional actuarial methods don't properly capture systematic risk. And so you're raising an important point, which is how do you properly apply reserving and accounting and risk management techniques from a functional as opposed to an institutional perspective, because you have the same functions being performed by banks, insurance companies, mutual funds. And so I think having consistency across function as opposed to by institution is probably the best way to prevent unexpected exposures to occur.
We have time for one more question, and I'll disappoint the audience and ask it myself.
Okay.
Because it's because it is relevant to the answer you just gave. A major insurer just lost its status as a systematically important institution. It's the second large insurer. I've spoken to both, and the line I get from both of them is we only got into this terrible situation of having this designation because of those dummies down there at AIG, and it was unfair all along. What do you think about the decision of regulators to move those large insurers out of the systematically important bucket?
Well, this was a topic of quite a lot of debate when I was the CEO and an activist campaign, to be honest. And I argued very strongly that being a SIFI was not an impediment to the success of the company, importantly because AIG had de-risked itself, and insurers tend to have rather low leverage ratios compared to banks. So under the SIFI regulation, that was absolutely not a constraint on what was a strategy to focus and return capital to shareholders. We bought back about $23 billion of stock without any bumping into any SIFI constraints. So, I think that a lot of the concern about SIFI or no SIFI is more of an ideological one as opposed to a practical one. It's for sure an additional level of cost, but as I mentioned, AIG had over 200 regulators, every single US state, every foreign jurisdiction, many cases multiple regulators in each of them. Having just one extra one was not that much extra work. And so, I think it's much ado about nothing. I do think having an overall primary regulator makes sense. Once the Fed exited from AIG, once it was de-designated, New York State took over that role. So you have to just ask yourself, is the system better with the New York State Department of Financial Services as a global regulator, or the New York Fed?
Great. Well, please join me in thanking Rob for his fantastic questions and Peter for his
Thank you, Peter.
answers.
Thank you. That was good.